Hello friends, welcome to AAFM, American Academy for Financial Management. I am your trainer Karim Lakhani. We have been receiving a lot of requests from all around to help them understand few concepts, and people have a lot of queries. They've been sending us a lot of questions, so we have filtered few of the questions, and here we are there to help you all understand and answer those questions. So the first one, how do interest rates impact the broader economy and financial markets? To understand this question, see, let us first try and find out that why would an interest rate change first? Because if there is a change in the interest rate, let's say if the interest rate changes, if it increases, for an economy, it is not good. Economy may come down. If an interest rate goes down, it would rather give a boost to the economy. It would help it grow faster. So any economy, any government, any central bank would want to keep the interest rates in control so that it supports the economy. Now, why would the interest rate change? Interest rates are going to change because of the inflation. If the inflation in a particular country is high, if it goes up, then it will lead for the central bank to increase the interest rates, because inflation and interest rates goes hand to hand. If interest rates goes up, interest rates will also go up. If interest rate comes down or inflation comes down, the interest rates are also going to come down. The reason why interest rate increases because the inflations are high, means there's lot of liquidity with the public. Public have lot of cash, lot of money. The money is available very easily. The money is available at a lower rate so that people are borrowing and spending money. So in order to control the spending, okay, or you can say overspending. So in order to control the overspending, interest rates will be increased so that the money becomes expensive, the rates becomes very high, and because the rates are high, people will stop borrowing money, and because they stop borrowing the money, they are going to say they will stop borrowing. If they stop borrowing, they will stop or reduce spending, and when they reduce spending, it will lead to the lower inflation. Okay, the cost, the prices of the commodities or everything will come down, and out of the essentials will come down, and it will lead to a little lower inflation. So this is the reason why the interest rates have to be changed. So if the inflations are coming down, government will also try to reduce the interest rate so that it will balance out between your borrowings and spendings. So sometimes they will support, they will promote people to borrow money and spend money to give boost to the economy. Sometimes they feel that the cost is so high, the inflations are out of control, so they will have to increase the interest rates. In the recent past, we have seen that during the pandemic, the interest rates were very low. But after that, interest rates have considerably gone up. When we talk about interest rates, we are talking about RBI ka repo rates, reverse repo rates. So why the interest rates went up? Because the inflations were very high. It was going out of control. So in order to have a balance, they had to increase the interest rate several times. Now today, with these measures, the inflations are quite in control in the last 2 years. Now, as we understood that if the interest rates goes up, the borrowings will stop. It is going to reduce the spending. And if the spending, so when this happens, you also have to understand that there will be a positive impact somewhere and there can be a negative impact somewhere. So when we talk about an economy, economy will have multiple things. One is the consumption. Okay. One is the real estate, or you can say housing. You can say the cash flows, and you can say the financial markets, including bonds, including stock markets, equity. Now, as we have seen that if the interest rate increases, it will lead to reduced spendings. So if there is a reduction in the spending, if the consumption goes down, it will also have an impact on your cash flows. It will also have an impact on the financial markets as well. Because the rates are high, if the interest rates are high, and if you have taken certain loans, so either your EMI will increase, okay, your outflows will increase, so it will have an impact on your cash flows. At the same time, because the consumption is not there, the business is not going to happen. If business is not going to happen, or the sales will come down, the profit margins will come down, it will also lead the stock markets to even correct a bit. So the stock prices are also going to come down. So it will have a direct and indirect impact on many things. You look at bonds. Bonds are also, when interest rate goes up in the market, when the rates goes up, the bond prices in the market will also fall. So wherever you have any investment in directly into the bonds or indirectly through mutual funds, some debt mutual funds, you will see that these things will come down. You will see stock markets will have a little negative impact. You will see that your cash flows are going to, your outflows are going to increase. Okay. At the same time, the real estate markets are also going to come down. Because whenever the interest rate increases, people will stop borrowing money and and they would not want to buy any real estate. And real estate is something where a bigger corpus is required, a bigger loan amount is required, a long-term commitment is required. So when you see that the interest rates are high, you would shy away from taking any loan. And most of the transactions in real estate happens because of the borrowings, because of the loans. If you are not taking the loan, you will not be able to afford such a higher amount of real estate. So people will stop buying real estate, the demand in the real estate will come down. So that is also going to have a negative impact. So, and vice versa. So whenever the interest rate falls down, the consumptions will increase, the real estate markets will also get a boost, your cash flows will also get positively affected, your bond prices will also go up, your stock markets will also go up. So interest rates plays a very, very crucial role, which is having an impact not only on one thing, but it is having directly or indirect impact on lot many things. And the entire economy is getting affected because of it. So it can have positive effect, it can have negative effect. I hope this would have helped you understand the impact of the interest rates on the economy and the financial markets. Thank you.